Okay, now on with the show, and to start off the first plenary session today on steering investors towards sustainable business, I want to get our Leadership Council member, Jim Miller, who is the VP of Operations at Google, to come up and chair the session. Come on up, Jim.
Thank you, MR. It's been wonderful to be associated with the Corporate Eco Forum since almost day one, I think. So welcome to day two. I hope you had a great dinner last night, and I hope you met some new colleagues, made some new friends, and had some inspiring and engaging conversation. So this morning we have a terrific panel to discuss something I'm sure that's near and dear to all of our hearts, steering investors towards sustainable companies. And with that, I'd like to introduce the category and the panelists. So Mindy Lubber, president of Ceres. We have Susan McCormick, partner at Morrison Foerster, better known as MoFo, which I've sat across the table from many a time. Dorothy Maxwell, director, TEEB for Business Coalition. Daniela Saltzman, associate, the Generation Foundation. And Beth Lowery, senior advisor to TPG Capital, who will be chairing the session. So Beth, I'll hand it over to you.
Great.
Thank you.
Thank you. Good morning, everyone. It's great to be here, and I'm sure the Corporate Eco Forum is thrilled to be talking about can we steer investors towards sustainable companies. All of you are doing some great work, and this is a great panel, so I really appreciate all of you joining today. I am now with TPG Capital, so investor side of things is something I pay a lot of attention to. It's a firm that was started, a private equity firm started in 1992. It has about over $50 billion under management. So lots of activities with respect to due diligence and how do we make the companies within the portfolio more sustainable. I just returned from a trip to London, and certainly there's an extreme interest in this issue, sustainability, ESG, from the investors in Europe. And also, obviously, it's growing in the United States, but there was no doubt that when our founder, David Bonderman, was there, he got questions on ESG and sustainability throughout the week that we were there for the responsible investment in PEI, PRI, all the acronyms with respect to private equity and responsible investing. And so what we're trying to figure out is, do people really care about these issues? Does it make a difference when investors are making decisions? Certainly, when we look at investments, we ask a lot of questions during due diligence on sustainability and ESG. And the limited partners that are investing in TPG are sending us more and more surveys with respect to what are we doing in this whole area. And so for private equity, it certainly is a growing area and a growing trend. So what we'd like to do is talk a little bit, have each of the panelists introduce their organization and their role with respect to that organization. And then we'll talk, just have a conversation about investors and do they really care about these issues, and talk about some of the tools and frameworks and some of the help we could have from this whole audience. So Mindy, you want to start?
Great, thanks. And it's fun to be here with Beth. I run Ceres. I work with many of you, but certainly not all of you. Ceres is an organization going on 25 years. The mission then, integrate sustainability into capital markets, is the mission now. We work to set standards of best practice for corporations on sustainability, work directly in partnership with about 80 companies, and benchmark about 600 other companies of the Russell 1000. We also work with investors. Our investor network on climate risk and sustainability is 104 companies, $10 trillion in assets, and we work with some of the largest asset owners and asset managers, so some of the largest pension funds, as well as money management firms, to further integrate sustainability into all that they do, their analysis, their research, their review of companies. And then finally, we work to change the levers of capital markets. So our investors work to get the SEC to mandate the disclosure of climate risk and water risk, not as a mission, not as a campaign, but because the financial implications of climate and the risk involved is a material risk that the investors thought they needed. And we're now embarked on an effort to get integrated reporting. I sit on the board of the International Integrated Reporting. How do we move from sustainability reports and financial reports to merge them into one? We're also working, and I'd say we're 2 years out from the stock exchanges mandating more information on ESG. We've got some recent news from NASDAQ, and we're working now with the World Association of Stock Exchanges. And finally, with all the financial leaders that we work with, business and investors, we work to bring that message to the Washington policy debate. And it is true, as Andrew Winston said. I want to say that at midnight last night, I got 5 emails from the White House saying, we are going to highlight the Ceres Declaration, and the specific vehicle is not the key, although many of you have signed it, and I invite everybody else to do so. It is economic leaders calling on Washington to act on climate as an economic imperative. And at midnight, the White House was saying, we are going to add more applause lines, everything's in applause lines in politics, to the fact that it's businesses leading this fight and businesses are engaged. And that was very exciting news. This is not an issue of we versus them, East Coast versus West Coast, Republicans versus Democrats, blue states versus green states, environmentalists versus business. If we are going to build an economy, a sustainable economy, we need to do it together, and it's people in this room who I believe are going to make a difference. So that's our story, and let me pass it on. I'll look forward to continuing.
So I do like the Andrew perspective on that and Mindy perspective on what's going to happen. So it'll be interesting to see how it all plays out.
That's right. We'll take some bets.
Good morning. I'm Daniela Saltzman. I'm with Generation. For those of you who don't know, just a little bit of background. Generation Investment Management is a sustainable investment fund. We have about $8 billion in assets under management, and we're headquartered in London. It was founded in 2004 by Al Gore and David Blood, who was the former CEO of asset management at Goldman Sachs. We have about 55 investment professionals based in London and an office in New York, which is where I'm based. We have 3 main funds. We have a global equity fund, a private equity fund, and a credit fund. And separate of those 3 businesses is the group that I lead, which is our advocacy group, the Generation Foundation, that focuses on trying to make the business case for sustainable capitalism. So trying to address investors and companies and really make the business case in a robust and diligent way around the economics of why sustainability is relevant to the business community. And we try and do that around 4 different channels. The first is through education and empowering investors, highlighting the issues and trying to give investors the tools to then go out and think about sustainability and then integrate it into the valuation process. The second is through highlighting corporate innovations. Much of the work that you all are doing and that I was lucky enough to hear about yesterday is a big part of our process of, again, trying to highlight what are best practices and how can we get markets to adopt them. And the third is supporting leading academic work. I think a lot of the innovation that happens is within companies, but also within the academic community of supporting new research that's happening that, again, is trying to make the business case for sustainability. And the last bit is really partnering with like-minded organizations, coming to forums like these and trying to engage with interested fellow travelers in the field and really get a sense of what's happening and how we can be additive.
Hi, I'm Suze McCormick, and as the gentleman from Google said, I am with MoFo. We are probably best known right now because we represent Apple in the Samsung wars, and we represent SoftBank as they are slowly taking over the world. In terms of my practice, it's split. I do about half of my work in the area of clean technology and alternative energy, and I can admit that in this room. That's really sort of that pays the bills so that I can really do my passion, which is actually working with a lot of people up here in the area of sustainability and impact investing. I have, in the corporate world, I am a corporate attorney. I'm probably best known for my expertise on the intersection between sustainability and both fiduciary duty and reporting, and we'll get to it later. But I was one of the drafters of the new corporate form in California, really shifting fiduciary duties in favor of shareholder-approved sustainable goals. However, for all of you at companies here, I will say, you know, with the business judgment rule layered onto the fiduciary duties, your boards of directors actually have a lot more discretion without legal liability to adopt broader and deeper sustainability and performance goals. And I teach at the Stanford Directors College on that issue. And I will tell you, I've taught at the Stanford Directors College for the boards of most of your companies for about 6 years. The first year I had to talk them into allowing there to be a session on sustainability and environmental issues. And now it's fairly accepted. So your boards at least know that this is possible and they understand what is possible and where the legal liability is. But there are a lot of, I think we'll talk a little bit later, there's still a lot of impediments to be able to adopting sustainability more broadly. I'm also on the board of SASB and believe very firmly that one of the ways that we can advance the ball in this area is really to have integrated reporting, to move from the voluntary disclosure, the 100 questionnaires that come in. I kind of view where we are now as companies being asked to produce an encyclopedia of information on every possible element that could impact the world around them for a very broad audience of NGOs and governments and investors, to moving to a world where we really parse through that encyclopedia and determine what is material to operations in terms of what the investors care about. It's making the business case, it's looking at issues like climate change and integrating them into a company's 10K and 10Q, and I think that's what we're going to be talking about a little later on.
Well, good morning, everybody. It's such a pleasure to be here. I'm Dorothy Maxwell, and I'm a director of a new organization relatively called the TEEB for Business Coalition. And just to explain to you a little bit about that, the coalition is a not-for-profit platform of many of the global organizations that have been focusing on valuation of natural capital in business decision-making for some time. And we were set up just at the end of 2012. And we build on a program called TEEB. And for those who are not familiar with TEEB, it stands for the Economics of Ecosystems and Biodiversity. And this was a program that was set up about 5 years ago, sponsored by the G8 and hosted by the United Nations Environment Program. And really it was all about developing the evidence base and the economic rationale for understanding environmental externality costs. And one of the publications that came out of that focused on how you apply these things in a business context. Anyway, the coalition builds on that and now brings this wider group of organizations to look at how do you actually do this type of thinking in a business sense, and how do you help businesses actually incorporate this thinking in their decision making, whether they want to use it in supply chain management, internal management decision making, whether they want to put it in corporate reporting, like the move towards integrated reporting, or whether from an investor perspective you want to incorporate it in how you do your ESG and disclosure. So that's our background, and just to give you a sense of the organizations that are working with us in the coalition, the Corporate Eco Forum is one, and other organizations that have been bringing together early adopter businesses interested in this topic. So organizations like Business for Social Responsibility, the Nature Conservancy, World Business Council for Sustainable Development. We've also brought together organizations that are working on this topic in the policy space, and that's really thinking if this agenda moves forward on natural capital and the metrics of how to do it start to evolve, there needs to be a consistency between that and what's happening in the policy space. So organizations like the World Bank and their WAVES program, organizations like the IFC, the United Nations Environment Program Finance Initiative and their Natural Capital Declaration, all these organizations are linking in with this as well. And then the other part is really about bringing in the businesses and the early adopters. So from businesses that really have high impacts from a natural capital perspective, the energy sector, the mining sector, the construction sector, some of the fast-moving consumer goods, these are the sort of businesses we're engaging with. Also the investor community. And one of the things that we're noticing particularly in that is the accounting world getting very interested in this topic because, of course, they see it as part of the way accounts will be done in the future. So a lot of the International Federation of Accounting Bodies, et cetera, are also working with us in the coalition. So really, we've brought all these groups together, and the idea is that we're going to focus on three things because we really want to use the fact that we're collaborating in a valuable way and to scale up action. So the three things are about growing the business case on natural capital valuation. What does it look like? We've done 2 pieces of research also to look at the drivers. Why would a business do this now? Why would an investor be interested in this now? We've also done a piece of research that looks at the priorities. Where can you leverage the most to actually get market transformation on this issue? And happy to talk about those in the following conversation. And then finally, the area we're going to focus our attention on is already we're starting to see a proliferation of tools and methods on the valuation of natural capital. So can we, through our collaboration, bring some sort of harmonization to this space at this point in time?
Harmonization, I think that would be very helpful. I think if you see all of these activities going on, sitting in a corporate sector, you're thinking, what do I get involved in? Do investors really care about this? What's going to make a difference? And so I'd like to have each of your perspective on, do investors really care? I mean, obviously, everybody in this room, we're kind of preaching to the choir. We all believe that sustainability and ESG is really important. But how often during those quarterly analyst calls, how often do people really ask specifically about sustainability, natural capital, ESG, and do investors really care? So whoever wants to take it.
So let me take a shot at that. And I want to say, Beth, I travel around the country, a little bit out of the country, and hear often that I never get a question on quarterly earnings calls from investors. So let's take that as a given. Generally, you don't. I want to say that despite that fact, and we're going to take it as a given, and let me also say 2 years from now, I want to be back here talking with all of us, and I hope that's different. But despite that fact, and it sounds highly negative, I'm going to argue that while the investment community is slow, just like many communities in change, the change we've seen is nothing short of monumental. And while the generations and the Calvary and the social investment movement, which I want to take us out of, has been talking about these issues for 20 years, and generations certainly leading from a more traditional, this is not a social issue. We are seeing the traditional pension fund community, asset owners and asset managers, and the entire investment community change. Again, I want to put the caveat, not fast enough. There are barriers, hurdles like compensation around short-termism. If everybody's paid on what you did for me over the last 3 months, it's pretty hard to say there's an incentive to invest in sustainability. But let me tell you what I am seeing. One is that some of the largest asset owners who own all of your companies are putting more requirements. They're allocating specific ESG requirements in every asset class. More money in green infrastructure, more money. Again, still small, relatively speaking, but not insignificant in the aggregate. We have seen a massive increase. We're at about nearly 10% of all investments invested in some kind of screened investments. Secondly, ESG issues are no longer ghettoized to environmental, social. Those are the religious investors. They are being debated, and they're part of traditional investment firms everywhere, and the research we're seeing. Deutsche Bank did a study last year that said 100% of the companies who are leaders on ESG have a lower cost of capital. Now, every company is interested in a lower cost of capital. Harvard Business School did a study that looked at 90 companies over a 17-year period and compared the 90 who were interested in ESG with 90 who aren't, and all 90, or 90% of those 90, did far better in terms of rates of return and shareholder value. So what we're seeing is hundreds of research reports coming out of the most traditional investment firms, goals being set by some asset managers about how many assets to put in screen funds, RFPs being put out by some of the largest investment firms by some of the largest asset owners to their asset managers telling us, how are you going to analyze climate risk, water risk? We're seeing investors go to the SEC to mandate it. We're seeing stock exchanges. So to imagine that this is not a very different day than 3 years ago or 5 years ago would be missing a number of signals we're getting. The rating agencies, each of the rating agencies has been in discussion with us and many, many others about how to analyze and evaluate for climate risk and water risk and putting that into their ratings. So these are no longer niche issues. They're no longer about what the religious investors care about. They're really all investors, and partially because of the order of magnitude of the risk. The property and casualty insurance sector saw a $50 billion loss over the last 2 years from increased storms. That's not a social issue. That's an economic issue that we must pay attention to. When the cotton crop dies, what does that mean to the Gap, to Levi Strauss? And investors know that the implications are growing, the risks are growing, and frankly, the opportunities are as well. So while you're not getting the questions on quarterly earnings calls, we still have what I consider the pernicious demons of short-termism, where everybody's evaluated on what you did over the last 10 minutes, and it's hard to show return on sustainability investments. But the numbers are growing, the interest is growing, the amount invested in sustainability-related investments are growing, that's all the good, and the shareholder advocacy is growing. When we see climate change shareholder resolutions go from 6 to 125, and from an average vote of 8 to an average vote now of 31%, it's investors who are looking at the risks, who are exercising their fiduciary duty, and who are taking an interest in sustainability. And I think we're only going to see more and more of that. So let's not worry about the quarterly earnings calls. One of my answers to the CEOs and CFOs who raised that with me in meetings across the country is, don't wait to be asked, just offer it. If in fact you're seeing return on investment from your sustainability investments, tell the story, show the story, document the story. That's exactly what we need to catapult and to turbocharge the interest of investors from slowly moving into this space to rapidly moving into this space.
I think I agree with Mindy. I do want to say, you know, when my practice and my background is mainstream corporate. I'm a corporate lawyer for big corporations traditionally and private equity. And the BlackRocks and the large money managers say, you know, if they look across their portfolio, you know, 90% of their investors are not asking. This is not just the quarterly returns. This is the people for whom they're managing money. 90% of them are not asking about ESG at all. But that was 100% 10 or 15 years ago. The fact that 10% are, unfortunately, a large percentage of that 10% are sort of have a negative as opposed to a positive lens. In other words, they don't do this bad stuff, and we're going to improve. And so I still think we have a long way to go. I often go, I flip-flop between sort of the Birkenstock, you know, tree-hugging world in San Francisco and the corporate world in San Francisco, and the Birkenstock tree-hugging, you know, really want to believe that investors care. And I think investors do care, but it's a question of, do they care more about, you know, things that they can't measure and they don't understand because they have, again, this volume of information, or they care more about making sure they have returns because they are managing the funds for, you know, hundreds of thousands of retirees in the California public system. I mean, it is, and what we need to get to, which is where Generation is and a lot of other people, is that there doesn't have to be this trade-off, and Andrew mentioned that. The two things I just wanted to mention, first of all, Mindy's exactly right. We have not seen this amount of increase in shareholder resolutions since executive comp. And you have to look at what happened with executive comp in companies. It started with shareholder resolutions. It took 10 years for the SEC to adopt rule change as a result of this. But the increase we are seeing in shareholder resolutions around issues of environmental sustainability is huge. It is the fastest growing category of shareholder resolution. That's number one. What they're asking for is a little nebulous. Do you have a climate change policy? Do you, you know, is this dealt with at the board? It's getting better, but it still is lacking in teeth. And the second thing I think is very important, if you don't remember anything from what I say today, just remember that the world class of investors is divided into ERISA and non-ERISA. And if you are an ERISA investor, you have significant constraints on how you can value and look at ESG issues, legal constraints. And as opposed to return. So tying them to the return is the only really way you can get them. If you're a non-ERISA investor, you have a lot more leeway. So just wanted to mention that.
I would also just add, I think when you ask the question, do investors care, you have to define the group of investors to whom this is actually relevant. It's never going to be a relevant conversation to day traders, for example. So the first thing is, well, this right now is a conversation around long-term horizons. So those are the investors that, first of all, should care. And I think a lot of them do. They're starting to get it, but they don't exactly know how to care. So sustainability is still sort of this nebulous topic in their minds. They don't know how to translate necessarily the theoretical aspect of sustainability to Excel. How do I model this out? What should I do differently when I go speak to a management team, or when I'm thinking about the diligence and evaluating a company's management quality or business quality? And to that point, at least in our work, we have published a white paper on sustainable capitalism a few months back already. And there are just two things that I would want to highlight from this paper. The first is a recommendation to investors and to companies around stranded assets. Now, some of you may have already heard this term, but the brief definition of a stranded asset is one that would change dramatically in value as a result of something coming to pass, whether it's social pressures or regulation. So for example, a stranded carbon asset is one that would be significantly impaired if, for example, a price on carbon actually came to be. And with the investor community, it's been really interesting because that recommendation has actually gotten quite a bit of traction because it's a little bit more tangible. It's working with the accounting firms and with management teams, and obviously within the investor community to understand what is my exposure in my portfolio to carbon risk. How do I then take that exposure and think about what should my next steps be? Is it divestment? Is it engaging with management teams to perhaps see how they can change their CapEx policies and transition to more renewable sources of energy? Or should I just put pressure on them to try and get more dividends, try and get my money out as fast as I can? And I think that those conversations have been really interesting because it's a way for the investment community to start to internalize what climate change risk, what sustainability risk really means in a 5, 10, and 15-year horizon. I think the second point that's worth highlighting in terms of do investors care is the work that SASB is doing, the Sustainability Accounting Standards Board, which was recently founded about a year and a half ago or so, and is an NGO based in San Francisco that is modeled in part off of what FASB, the Financial Accounting Standards Board, has done to try and identify the key sustainability metrics on an industry basis so that companies who I think at this point experience some sustainability disclosure fatigue between the various platforms to report on sustainability metrics, can now say, okay, we're going to take a lens that's a bit different from what we've done in the past and focus exclusively on material issues. And that's an important advancement, really, because now investors can say, these aren't just sustainability issues that I don't really understand, and I'm not a sustainability person or an environmental officer with my company. I just, it's not relevant to me. It's relevant because these are key drivers of profitability in the long term for a company, and the SEC will hopefully agree that that is the case. And it allows for historical, comparable sustainability metrics to then be used within the investor community to further embed integrating sustainability into the valuation process.
I'll just say once it's material to operation, so you're taking an SEC definition, and once something has to be reported on a 10K or a 10Q, it has to be measured in a realistic way and verified and then reported. And then again, what's exciting for all of us is once with integrated reporting, once it has to be verified, measured, and reported, people want to start improving because people will see the direct, because it's in the 10K and the 10Q with the financial information, and the tie again is clearer.
Just a very quick response to both of you, and then I want my colleague to go. You mentioned shareholder resolutions not always being specific enough, and Daniela mentioned stranded assets. There was a series of meetings by some of the largest institutional investors, and this is just to transmit what I'm seeing, hearing over the last 2 months, where they came together and are looking at what stranded assets really means in the fossil fuel industry, if in fact half the value of an oil or a gas company never comes out of the ground, if we're ever to reach a world that could sustain itself. What does that mean to the value of the company? And what I'm predicting, and for those in this industry sector, I think we ought to talk about it to figure out how to address it. There will be shareholder resolutions this coming year. There are letters going out from some of the largest institutional investors to fossil fuel companies now. and the expectation is that they see this as a huge financial risk. Again, not a campaign, not about climate change, but about shareholder value, given the order of magnitude of what it really means if large fossil fuel companies have to leave half of their value underground to sustain a world. And so investors are focused like a laser going into this shareholder season and this summer and fall, and we're going to see more and more about it. And they will be asking those fossil fuel companies to stress test the economics and value of their firm and to report back to their board and to the investors. An interesting coming together of the 2 points you both made.
Absolutely.
I was in St. Louis a couple months ago with a coal company discussing that.
Thinking of the natural capital valuation side, my sense is that this is at a much earlier stage than the more broader, more mainstream at the moment ESG assessment in terms of sustainability. Because what we're talking about in valuation is putting an economic value to understand the true cost in its fullest sense, externalities plus of damage from greenhouse gas emissions, air pollution, waste generation, and so forth. This is really new territory, and the sense that I get from the investor community is a lack of understanding of what that really means to a large extent. And I think that businesses who are in sectors that draw heavily from natural capital, and of course energy would be huge, and the stranded asset message surely has gotten out there, so there's a lot of interest from that sector. Those are the sectors where there is engagement at the moment, and then the investors who are investing in those sectors are starting to get interested. And one of the pieces of research that we've done is to try and help put numbers on some of these things, because in certainly natural capital valuation, this is very abstract. And until you can get a sense for the scale, it's really hard to actually start to tackle it, particularly from the investor side. So we did this study called Natural Capital at Risk, the top 100 externalities of business. It's on our website. If anybody's interested, I have a couple of copies, or I can give you the website offline. But basically what it does, it gives you the hot spots. So it puts the natural capital cost on the highest impacted sectors from a natural capital perspective. So those that offer the biggest risks or the biggest opportunities, depending upon how you want to look at it. So just to give you an example, energy comes up very high. You're looking at a figure in terms of externality costs of roughly around 300 billion per annum. That's enormous figure. Other sectors that come up high are mining, really anything that's using land in terms of food production, so all the agricultural commodities come up very high. Some of the fast-moving consumer goods like cotton has been mentioned, comes up very high. And basically there's numbers there for that, just to give a sense. And when you look at those kind of externality costs, you know, of the order of 300 billion per annum if you're in the energy sector, if you had to internalize those costs tomorrow, obviously there's huge implications for the business. So understanding those priorities, I think, is very much the first stage of engaging investors on this topic and understanding the level of risk. And then beyond that, let's get better and more refined at how we measure it. Because at the moment, the techniques for doing this type of thing really come with a lot of health warnings. This is for sure hotspot type of analysis in terms of those numbers, because you know they are huge.
And if I could just add from a practical perspective, one of the reasons I was very pleased to be asked to be here is one of the key things you can do is work with your direct competitors. Because if you read all of this work, listen to Mindy, listen to Daniela, you get it, you understand the impact on, say, Google, you go back to your company and you go to the general counsel, you know, we've got to start, and your operations people, you know, we've got to start internalizing these costs, we've got to put it on our P&L, we've got to report it, and you do, and there are additional costs, and your stock price drops, you're going to be sued. I mean, every company that has a stock price drop, there are thousands of little, you know, securities lawyers out there that will look for a reason and sue you, and if you are reporting something in a way that is different from all of your competitors, you're going to be screwed. And so what you need to, what has to happen, and one of the reasons I got on the board of SASB, and I'm so excited about Ceres, is you're all going to have to work together to figure out, all of the cotton industry needs to figure out the externalities, the natural capital costs, and go in that direction. There are just two things, legal things you have to consider when you start working together. One, if you're in the US, well, actually if you're anywhere, but particularly in the US, is antitrust, and the other is trade secrets. So I can elaborate more on those, but those are the two impediments when industry comes to, significant legal impediments when industry comes together, but industry is going to have to come together to be able to do this.
Right, and I don't think there's any shortage of coalitions and activities where people are trying to do that with those precautions. So I think the people in this audience are very familiar with making sure we don't get into any antitrust problems or anything like that. But let's talk a little bit about integrated reporting, because that's been brought up, and trying to figure out how you bring these two together. The financial system has been around for a very long time, and investors are very used to looking at the numbers and doing the spreadsheets, and we've done some great work on corporate responsibility reporting. Mindy and I were laughing about GM's first environmental report when I was at GM, which we won't tell you how long ago that was, and then going into from a Ceres report to a GRI report and working through all of that. Well, integrated reporting, I think, is a very important development, but I would like to get a sense from the panel of, where you think it's going, how will it actually take place, and how often do you think it will, or how soon do you think it will be before companies in this room will be filing integrated reports?
So let me take a shot at that. I want to say one other thing about companies in this room and other companies. This is the first time in the 30-plus years that I've been working in advocacy where companies are so far out ahead of policymakers and investors.
Sure.
And so we're asking, do investors care? And I'm a little bit mentally challenged on that. I'm fairly normal in every way, but schizophrenic. Some days I wake up and say, God, we're making great progress with investors. CalPERS is in the middle of a board process. They own $240 billion of all of your shares, and developing a beliefs document on how to drive all of their investments. But then I look at how theirs and everyone else is managing their money, and it's based on short-termism. So investors do care, but I do want to put it into context that it's slow and that you all are out ahead of them, and that's just the reality, good or bad. Over to integrated reporting. I think I may be, despite the fact that being on the board of the International Integrated Reporting effort, I may be a little more judicious in when I think it will land, 3 or 4 years, I would say at least. But things take time. When Ceres launched with General Motors, frankly, and others, the Global Reporting Initiative, people said nobody's going to use GRI, too complicated, too messy, and now 4,200 multinational companies are using it. It's developed, it looks significantly different, and I think it's made a great contribution to transparency, to management, to systems, to all of us. But the reality is, it has made a massive difference for management. The little ditty of what gets measured gets managed is true, and companies are managing their footprint far better knowing what that is. It makes a huge difference to stakeholders, people in communities who need the information, people in different sectors. What we are hearing, and we can't ignore it, is that investors and analysts are not using it. Whether it's too long, it's too much information, despite the fact that it's gotten more metrics driven, and it's not a picture book anymore about what corporations are doing in their philanthropy, and philanthropy is a great thing, but it is not about what we're looking for. We need to make it usable for the financial analyst, and if we don't, then we've lost something. I will say that there is some sense that we'll have financial reports and we'll pull out 3 or 4 or 5 pages of the sustainability report, staple it on, and we've got an integrated report. That is most definitely not what we're looking for. We think about companies in how you integrate sustainability from the boardroom to enterprise risk management, to R&D, to strategic planning, to supply chain. It's got to be integrated on a risk and opportunity basis into the way companies manage, think, plan, and move forward. And the same for an integrated report. It is not about just a few pages from a sustainability report. Let's find the best metrics and staple them together. They've got to be integrated. It's very complicated. We're all commenting on the next round of IIRC language, and I invite you all to do the same, and we're happy to share our formal comments. We've got to make sure that we don't lose much of what we've built together with everybody in this room, because sustainability reports are more than capital, excuse me. They're a way to engage stakeholders, and every study shows that corporations that fully engage stakeholders do better. And so we don't want to throw out the metrics that show a community what the toxic pollution is in their water or in the air. And we don't want to throw out metrics that show the Latino community, what it means to their sector in terms of employment. There are all sorts of information, material information, important information, but isn't all the traditional capitals that go into financial reports. And we've got to find that right mix. And I think we're not there yet. We need all of you commenting. I hope it's 3 years and not 4 or 5, because it's essential. We'll never move out of the ghetto of ESG over there and the real world of finance over here until it's all integrated, as so many of you are doing at your companies. It's got to happen in reports. So I don't want to hear 3 years from now that no financial analyst or very few are reading these reports. Companies spend an enormous amount of time and money preparing exceedingly compelling, metrics-driven sustainability reports. We need everybody using them. And if it means taking a substantial amount and integrating it, we're all interested and prepared to do that. But we don't want to lose the substantial progress that we've all made together and that you've all done in your extraordinary, compelling sustainability reports.
Right, and it's the internal stakeholders as well. I mean,
Yeah,
the
fair
reporting
enough.
has really driven better management across the companies and really engaging all the various functions. Those reports are, as you all know, very challenging to put together, and when they're done well, it really drives change and the culture within the company. So we don't want to lose that aspect as well.
Well, let me just say, just for definitions, the IIRC is kind of looking at this in an international integrated reporting. SASB is looking just at the US, and Mindy also mentioned the INCR, which is looking at improving the listing requirements, just if you hear those phrases. I disagree with Mindy. I think it's going to be 1 year. I think it's going to be next year. I will tell you why, and it's because SASB has 17 sectors. They're going sector by sector. They started in healthcare and pharma. Then they moved to financial, then they moved to technology and communications, and then now they're going into non-renewable resources. The healthcare is out there if you want to go to the SASB site, and they actually have already determined, working with companies, investors, and NGOs, what is material to operations. And what was fascinating to me as a corporate lawyer was the factors and how they are going to come out with specific guidance that we've drafted in terms of going from boilerplate language in most cases to very specific language in the MD&A section of the 10K and the 10Q. And the only thing I will add to what Mindy said is what I helped Intel draft their climate change, because we do a lot of work for Intel, and I reviewed it for MoFo, first risk factor years ago, before anybody else in the Valley was putting in risk factors around climate change. What you have to understand about your reporting is the first thing little lawyers do when they're asked to review a company's 10K and their 10Q is they're asked by the partner in their firm to get the 10K and the 10Q of every competitive company. So as soon as one bio or pharma company puts in the MD&A, in the MD&A section, these sustainability metrics, somebody else is going to pick it up. And again, SASB has combined, and if you look at all of the big companies and big pharma, almost all of them commented. They've already weighed in on what is material to operations. And so I am hopeful that it's going to be next year, and we'll see. We'll see where it goes.
So could I just give you a high five? I'm happy to be disagreeing
Happy to be wrong.
on this one. I would love to be wrong, and I think you could be right.
And it's all going to be the uptake. We've already had 3 meetings with the SEC, so they are behind it. And the other thing that I just wanted to mention the word restatement. I was very concerned that when you add material information to your 10K and 10Q as a company, if you put something new in there that you didn't put in last year, you're saying now it's material to operations and last year's it wasn't. And that begins to look like a restatement. Restatements breed litigation. They're just bad news. One of the most reassuring things, having finished the bio and pharma industry for SASB, is that almost everything that was deemed material to operations was in some 10K or 10Q for a company in that sector, usually in sort of boilerplate language, like climate change might affect our operations. And really what SASB and the integrated reporting is saying, let's go from boilerplate to, let's go from the general to very specific information that investors can use to analyze the impact of climate change on the operations of this company.
What we found on the natural capital valuation piece of this is that it's a little bit similar to what Mindy has described. You know, we're talking with IRC and GRI about what this would look like in the future in terms of the applications, thinking about the EP&L and other forms of disclosure, what companies like Puma and Caring are doing in terms of putting it in that. But we're not seeing too many companies, businesses, interested in using those external-facing applications just yet. And it's largely for the reasons that you described before. There's a lot of uncharted territory here and potential implications when you disclose. So our experience so far, and this is varying geographically, but if we just take the Western world, is it's more about looking at natural capital valuation and using it in internal decision-making, whether it's organizationally, like Dow Chemical have done fantastically for green infrastructure type of work, or companies like Puma have done in terms of understanding their supply chain and decision making. And also given that some of the big drivers in this space for business are about resource scarcity or responding to erratic weather conditions from climate change and all that brings, et cetera, as an immediate application, it's those internal management applications that really don't involve a disclosure type of route are the ones that we're seeing likely to come first before the corporate reporting applications, et cetera.
I would just add really quickly that I like to remind myself in these conversations around integrated reporting that, in fact, integrated reporting isn't the goal. Sort of what Mindy was saying before, it's integrated thinking. And to remind ourselves and to remind management teams that the point isn't to have a faster, cooler annual report website that brings up all these pictures and allows you to select different parts of the annual report more easily. The point is to really think about core and material sustainability issues during questions and conversations around budgets, around strategy, risk, and opportunity. And that really is the purpose of integrated reporting. And I think to the point that you were discussing earlier around stakeholder engagement through this process, the other thing that I like to remind myself of is even with the great work that SASB is doing, we have this list of material sustainability metrics. That which is then deemed immaterial doesn't mean it's not important. And I think that's important to keep in mind because these are still issues that are worth discussing, are worth keeping in mind, are relevant to some stakeholders, but are unlikely perhaps to impact investors' capital allocation decisions. And I would just briefly, although I'm not on the board of SASB, Generation is an early supporter of the company, use this opportunity to promote the corporate pilot program as a call for action for all of you. So SASB, starting next year, will start to engage with various companies, starting in healthcare and financials, sort of tracking what they've already done in terms of identifying the metrics on an industry basis, to work with CFOs and CSOs within companies to help really integrate the identification of these material issues into EDGAR, SEC form filings. And so there'll be structured engagement for 3 to 6 months with accountants, lawyers, consultants, PR reps. It's absolutely a party, as you can see. And really working with these companies to try and help them adopt integrated reporting on a material level. And so if any of you are interested, you can obviously contact any of us or SASB directly.
On that note, let's open it up for questions from the audience. Yes. A mic is coming your way.
I'm on my way, Avi.
My name is Avi Sahi, and I'm with Nike. Thank you first to all the panelists. The work you're doing is very important and relevant to catalyzing the understanding of the work everyone in this audience is doing. My question is, in the observations you shared with respect to do investors care, I'm just curious, with large pools of assets gathering in Asia, are your observations inclusive of the conversations occurring with Asian investment managers, both focus on liquid and illiquid, or not? That's all.
Good.
Well, I'll share my limited view, which is not all across the investment spectrum. But our investor network on climate risk and sustainability works in partnership with investors in Europe, New Zealand, and Australia, and Asia. We just launched our Asian program through an international conference 2 or so weeks ago. And I will say that the analysis and focus on environmental and on climate risk and what it means to portfolios, and largely it's an issue that is so apparently material. The impacts to dozens and dozens of sectors, from agriculture, floods and storms, to what happens in hurricanes, to insurance sector, the list goes on and on. And so the interest on the part of Asian investors in climate risk and how to address it and how to work with the international community, including investors wanting to engage on policy, has been substantial. Now, that doesn't answer your full question on liquid and illiquid assets.
Yeah, my perspective is we represent one of the largest sort of government funds out of China. And they do see the link more directly than even some of the institutional investors we've talked about here between sustainability, just because of what's happening there. They understand the business case that people are trying to draw in the United States, because they see it and they live it. And it's obviously about, it's about maintaining power. And the division between liquid and illiquid, that I don't know the extent to which they are dividing I don't have insight into the extent to which they're dividing their portfolio, and they're making their investment decisions on that basis. But I know they're making a considerable amount of long-term investments because I see the linkage.
I can't help you on the liquid either, unfortunately. We have a base in Singapore, and we've done an awful lot of outreach in the Asia-Pacific region. So in terms of the wider just awareness and understanding, what we have found is that very simplistically, I think the business case understanding and awareness level is running about 5 to 7 years behind the US and Europe on this particular topic. I think that gap will probably close quite quickly, and particularly because of the strong interest in integrated reporting in Asia-Pacific region, and that being a lever that really seems to work culturally. Perhaps that might even move quicker, but that's been our experience so far. So in our work in the coalition, it's quite a different message and an earlier message around awareness raising than it would be for American and European audiences. The other thing, that it maybe is just worth highlighting in that part of the world, when we did this study on natural capital at risk, we pulled out the priority sectors, but we pulled out the priority world geographies where the natural capital costs are the highest. And Asia Pacific is coming up no surprises for so many of these sectors. So in actual fact, the real risk is mostly in that part of the world. And therefore, the urgency is particularly for those geographies.
Okay, other questions?
I would just counter that. So back to my coal, in terms of investment in sequestration, which we're going to have because we're going to be using coal for the next 40 or 50 years at least. It's in China. The asset are investing in China. They're not investing in the United States, other than Summit and a couple minor things. They're investing heavily in Chinese projects.
And that is the #1 sector and geography that has come up in the ranking of this report. Is coal-fired power generation in Eastern Asia, mostly contributed to by China. So that's the highest one.
But just to say something, we are, as a world community, we've got to address these problems at scale at some point. And the sheer conflict in what you're saying, which is the reality, I'm not contradicting it. I mean, in China, people can't walk down the streets due to air pollution. Malls are being shut in Shanghai because there's not enough water to drive the hydroelectric facilities. These are economic risks, massive economic risks to the country. And at some point, more investment in coal and more burning of coal will come home to roost. Again, not only as a public health and as an environmental issue, but as a bottom line financial issue. We're seeing the Chinese government do more on acting to put regulations in place. We're still living in a world where it's all contradictions. We understand the problems. They're public health, they're national security, they're economic. They are very real. We're not talking about sustainability metrics, but economic metrics. What does it mean when malls shut down because there's not enough water? And at the same time, we're seeing an increase in carbon emissions through more coal. I think we collectively have to find a way to start dealing with that kind of contradiction, because you can't have it both ways. And to solve these problems, we're going to have to really look at scale.
There's a question back there.
Yeah. Hi, Jim Davis, KPMG. First of all, I have to ask, is that couch as comfortable as it looks?
Yes.
That's a great setup.
Pretty good.
Yeah.
It is.
Pretty good.
So thank you. This has been a great discussion. The question I had was actually one that we had discussed yesterday on the panel on integrating business and sustainability and business metrics in that conversation. The question was asked, do investors really care? And everyone says, yes, they do. But then, so why don't they really explicitly look at this as part of investment decision making? And the question on the table was, is it the methods don't exist? Is it the data doesn't exist or isn't credible? What is the real challenge for businesses in doing a better job in gathering the information? And do we need to agree on the methods before we do what, like what Puma's been doing? Or do we just go do it and get the data right and then worry about the methods later?
Well, it's interesting to me because I think that as a community, we've kind of isolated ourselves with respect to some language. So I think one of the most critical things we can do is speak the language of the people that we're trying to convince and persuade, which is why all this work going on with investors is really important. I also think in the role that I have now, whether it's due diligence or working with our portfolio companies, a lot of this, we want it to be integrated into the business. So it's, the good management teams have ESG sustainability as part of creating value. When we look at investments, we don't always walk away if there's an environmental issue. We will look and see if we invest money in this particular company, can we improve the environmental conditions and concerns. So I think it's, it's a challenge because in some ways we want it to be pulled out so people will ask about ESG and sustainability and environmental issues, et cetera. In other ways, we want it to be integrated into the business. So if it's a really well-run business and has good returns and everything is running pretty smoothly, you know that the foundation of environment, social governance, sustainability issues are generally part of that overall company effort.
I think that there are things that companies can do to signal to investors, not only discussing it and gathering the information, gathering the metrics and disclosing them, but signaling that the company is oriented towards creating long-term value. For example, trying to rethink the default practice of issuing quarterly earnings guidance. Perhaps it doesn't make sense for your company, given the industry that you're in, or the cyclicality of your profit cycle. So perhaps by stopping earnings guidance and thinking about trying to communicate to the investor community that, in fact, we're looking towards the long term, we're thinking about what drives our business to continue to be profitable in a more holistic sense. Things like that will inevitably create a little bit of maybe short-term challenges with the current investor base that you have, but in some ways signal to the investor community at large, the analyst community for sure, that in fact we're thinking about things on a long-term basis, which inherently is part of the sustainability discussion. I think that gives management the longer-term horizons that they need, but to, again, try and take it from the investor perspective, trying to incentivize patient capital is another way of trying to tackle the problem. So for example, there are new ideas around loyalty-driven security, so rewarding those investors which stayed with the company continuously for 3, 4, 5 years. And that's an idea that we've been exploring to see how else can we try and incentivize patient capital, attract investors who are willing to give management those time horizons necessary to create long-term value.
And I'll just say, I think there are really two reasons. Back to the original question. Number one, it's actually having data and having what we're all talking about that can be verified, information that can be verified and then reported in a realistic way. And the second is, while it's fabulous, everybody's focusing on this, the companies are more than the investors, but the example I'm given by the institutional investors is, you've given me 30,000 data points in terms of sustainability. There's so much information there. You guys are getting questionnaires on hundreds of things, parsing through that and determining what is really material to your operations now, and then putting in place a process for it to evolve, I think is really I think it's all what we've all been talking about.
Yeah, I think the big challenge at the moment is on the method side, a clear route for how to do this. And it's ironic because, as many of you will know, externality calculations in a purist economic sense, I mean, they're there for 20 plus years. But in terms of the applications that we're talking about here and going broader in terms of environmental, and we haven't even talked about social impacts as well, this is really new territory. So I think first step, clear methods. We have some great leader examples that have already started to move into this space. We can build on those. But then the next thing that needs to happen is to help businesses and investors is to simplify. So we need the tools that can support, and for sure we need the data, which is embryonic at the moment. And before the investors can do anything useful with all this data, the businesses have to generate it. And my sense would be, if we're really looking at scale and we're looking to leverage, as John Foley from University of Minnesota encouraged us all to do on the first day, which I totally agree with, let's focus on some of these high priority sectors that really have the largest risks from a natural capital perspective first. Let's look at energy, let's look at mining, let's look at construction, fast-moving consumer goods, agricultural commodities, and those really can shift the market quite quickly if you start to get the tools in place and then the investors interested to look at it from their perspective.
So I just want to not contradict, add on, not having enough, while there is a lot of data, there's a lot of useful data out there. So it's a bit of an excuse on many parts that there's not enough information, and you're saying there's over-information. There's useful information that everyone could use. Look at the fastest growing, the far most used new product of Bloomberg. We all have Bloomberg terminals at our office. They've got a platform around ESG metrics that are useful, that people are using. Thomson Reuters has followed. There is good information out there, and investors are starting to use it. Now, part of it would be to have better tools, and we all want that, and of course, we ought to keep striving towards it. But investors have to also decide it's important. The fact, as I said, that CalPERS, as an example, is confirming investment beliefs at the trustee level over the next couple of months will then drive what their asset managers, what their money managers have to do. So part of it is good data and mechanics, and I don't want to underestimate it. But part of it is getting the investors to make the right decisions. When the largest asset owners decide it's important at a trustee level, they drive their money managers. They put language into their RFPs, which already is being done in a few cases, saying we will hire money managers to manage our private equity, our public equity, if you have a capability around ESG assessment. So we've got to start at the top as well. Part of it's mechanics, and part of it is looking at fiduciary duty, investment beliefs. We're trying to drive that through at the largest pension funds in the country, labor funds, public pension funds, because we've got to go at it from both the top to the top beliefs to the mechanics coming up.
Yeah, Stefan Heck from McKinsey. I'm pleased to hear how quickly you think this will actually unfold and the timeline, so that's very encouraging. I had two closely related questions on materiality, where I see things a little bit more difficult than the kind of broad alignment that you're describing. One is on the time frame, right? You mentioned it's not for day traders or even one-year investors, but I still do see a difference between the typical business horizon of 5 to 7 years, given the length of time that executives are in place, and a long-term pension fund that has liabilities stretching 20, 30 years out. Because I see very different effects kicking in those time frames, right? If we're talking about oil reserves being devalued, that's really more a 20-year phenomenon. Storms hitting or water shortages, that could happen in the next 3 or 4 years, so those are very different time frames. The other one, closely related, is you mentioned the risks, which is shared by everybody in an industry, right? So there's broad alignment. We could all get hit by those. But if you're looking at income statement effects on earnings, on pricing power, and on revenue growth, often you see a phenomenon where first movers get an advantage. So there really isn't that same incentive for everybody to move together, because you won't capture the same benefit. I'd love to hear how you think the time frame and that difference would play out as this begins to really take hold on a broad scale.
So just very quickly on that, I think if there was one thing that would tie together companies and investors, and that's time frame of compensation. Because even the public pension funds, who you suggest have a long-term time frame, if their money managers are reviewed and getting compensated based on what they did today, 6 months in a year, their time frame is a year. And that's what we're seeing. They may have long-term obligations, but their money managers are getting the message. We're looking at what you produce over the short term. So if we said that CEOs and the leadership of firms and leading investors would make compensation a longer-term methodology. And it's not going to be 10 years, but it might be the 3 to 5 that you're talking about. We might start seeing a consistent change in integrating sustainability. And unless we change that compensation, we're sending a very strong signal that the short term is all that matters to both companies and to investors. And I would argue that's a challenge we need to take on together.
And I would just add very quickly to your first point around reconciling the fact that the impairment in oil, gas, and coal space will be 20 years off, but these superstorms are happening with greater frequency. I think the two will move in parallel, in fact, because we need to, according to a recent report by Carbon Tracker, we need to leave about 60 to 80% of proven, listed fossil fuel reserves in the ground today if we don't want to surpass the 2-degree threshold that scientists, for the most part, have a consensus around that would be a very dangerous and sort of unprecedented territory to enter into. So in fact, the impairment needs to happen now and not in 20 years to sort of bring those two things in alignment.
Other comments?
The first mover, maybe if I just take that one, it's a really interesting point. I mean, yes, there is a first mover, and I think, companies like Puma have, with the EP&L, have a lot of risk benefit, but also reputational benefit from doing that. But I think that perhaps in this area, it's not such a big issue because it is all about risk management at the moment. So from that point of view, there is something in it for any of these high impact sectors to actually start moving quite quickly on it.
And I'll actually make my final statement, which kind of relates to this. So I was born and raised in a small town in North Carolina. Started my career in New York and now work in San Francisco. So I feel like I've covered all the gamuts. And I used to be a Republican, and now I'm nothing. And I'm very interested in what Obama is going to say later today. And to me, so I'm going to go back actually next month to rural North Carolina, where I'm from. And all of these issues, it really, for me, has to do with the mispricing of natural resources. So I do focus much more on the risk and cost sides, because I think people are going to, the better companies are going to take advantage, and they're going to get the first mover advantage. This is all really to do with the mispricing of natural resources and climate change. And climate change, we haven't really talked about it, is really like death. I had this realization recently. It is so big, and we all get it. The boards of our company gets it. The investors get it. You guys all get it. We get it, but it's like we all know we're going to die. Do we sit around and have regular discussions over dinner, over death? No, and we can talk about climate change, but the fact that it's everybody's involved and everybody's contributing to it make it so huge that it's almost impossible. And when I go home to rural North Carolina, I can get people, everybody's talking about the weather, because if you look at what's happening in the South, the weather is changing. And I can get everybody around my parents' dinner table to say, yes, the weather is changing. And then I can get people to say, yes, and we think that, maybe does man have some impact? Yes, man does have some, maybe 2%, 5%, they don't go to 90%, but they all get it in a real way. So then what are we going to do about it? And I guess my final statement is I think we need to start looking at the bigger solutions. This is why I didn't get to talk about it earlier, which is why you can all do a lot with sustainability with your existing corporate form. I think we need to be thinking about new corporate forms, not B Corp labels where everybody self-monitors, not that that's bad, but really shifting the fiduciary duties. So raising to the level of shareholder value the drivers behind the behavior. So that we can put environmental sustainability and social factors on par with shareholder value. And I really think it's only with those bigger solutions that we're going to be able to combat some of the issues, which is what Ceres is working on in generation, and I know TEEB is working on as well.
And Susan's passionate about corporate forms.
I am passionate about corporate. I didn't get to talk about it today, but if you want to talk about, for me it all comes down to corporate form.
This is the first time you haven't been able to talk about it. So anyway, join me in thanking the panel for a great discussion. Thanks, Beth. Great job.
Is that an okay ending?
Don't run away yet. I get the enviable task of trying to encapsulate what we heard. So first of all, thank you very much. It was a lively discussion. I think we could probably have gone on for another hour or so easily. Let me cap what I heard. So first, sustainability is an economic and a business imperative. At most of our companies, sustainability has graduated from something exogenous to manage to a board-level conversation and something that's showing up on our 10Ks and our 10Qs. We do have a long way to go, and I, of course, don't want to dash any water on it, but there are some promising signs. So sustainability is starting it is a material issue. Investors are starting to take note. Boards are talking about it. It's showing up as risk management conversations frequently. I know it does at our board. The 10K and the 10Q, it's starting to show up, again, particularly as a risk management item. I think as business leaders, we have an obligation to teach our shareholders about why we're doing it, why we're doing sustainability, why it's important to our business. And as business leaders, and I would contend, most of us sitting in this room are here because we're leaders. And I think history has shown us time and time again that there are leaders and there are laggards in industry. And the leaders, they create new products, they create new markets, and in doing that, they create additional shareholder value. And I think it's our obligation to continue to go down this path. Leaders usually don't wait to be told what to do. They have a intuitive sense around what's right to do, and they go and execute and do it because it's the right thing to do. And I think all of the short-term focus and the P&L implications, they'll all work themselves out in the long run. I want to bridge to what we heard last night. So, Hannah from Nike, I think we heard that sustainability and innovation are different sides of the same coin, and that's certainly how I think a lot of us view this. And then Kurt, I don't know if Kurt's here or not, but if you haven't written, I know you haven't written your article, hurry up and write it and publish it into CFO Magazine. I think that would be highly advantageous to the cause that we're trying to drive here. And then finally, industry, we need to come together. I think from the gentleman from Minnesota yesterday, this is a scale problem, this is a systems problem. We can't really go solve this problem in our local markets. It's got to be done at the global level. Finally, a public service announcement. So we are going on break. We are reconvening at 10:30 in the breakout rooms, and then we're coming back here at noon for lunch. All right, see you in a few.